Hi everyone, this is Jason Burak of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today we have a first-time guest on our podcast. It's Dave Skarica, who's an investor and trader, and he's been making a lot of money for a long time in the natural resource sector. So thanks for joining us here today, Dave.
It's good to be here.
Thanks, Dave, and we're finally glad to have you on a podcast. So let's jump right in here with our first question here, and it's about the markets in general. Do you think the stock markets in general are going to go sideways until after the presidential elections?
I think see, the thing is, I have a little different view than most people, and I'll get into that in a second. But I think if you're looking at the S&P 500, I'm pretty bullish. There's a couple technical things that happened back in the summer and late fall that have me thinking that we're going to be going to 14 to 15,000 on the market over the next year or so. But mine's a little different kind of frame of mind. Now, I guess in terms of the actual presidential election, I think no matter who wins, we'll push back the fiscal cliff for at least another year. So that will definitely kind of help the market. And I think what we're seeing now, like Intel had some good earnings, Goldman Sachs had some good earnings, because the bar has been set so low, we're kind of going to beat a lot of these earnings. So actually, we may continue to rally here in October. And seasonally, usually when you see a decline in October, it's over the first half of October, and then you rally afterwards. So we could remain in this range, but I tend to be more on the bullish side. But the reason I'm actually more bullish has nothing to do with the U.S. election, is that now that Europe has started its kind of quantitative easing or monetary analysis, stimulus, I think that Europe, which markets are much more beaten up and much cheaper, is now starting probably a 1 or 2 or maybe even 3-year bull market in European equities, which began probably in the summer. And so it's essentially where the U.S. market kind of held up better than the European market over the last couple of years. Now I think actually Europe will kind of be dragging the U.S. higher. And I think that, Europe's in a recession and probably will continue to contract at least over the first half of next year. But I think you're going to start seeing the bad news in Europe get less bad, and that will actually drive markets higher and drive the U.S. market higher. So I guess we could remain in this range until the election, but I think actually what's going on in Europe is going to have much more of an effect over the U.S. stock market than the presidential election in the U.S.
That's some very interesting ideas there, because there was a lot of flight capital that was coming from, the emerging markets that was leaving, like the Chinese stock market. It was going into the U.S. bond market. It was going into the U.S. stock market. And even a lot of European money was, especially that hot money, that hedge fund money, was coming in here to the U.S. markets. And then you have the Fed, who's also giving, the Wall Street banks fresh new dollars to speculate with. They're taking all that garbage off their balance sheet and giving them fresh new dollars to put into the markets there. So it's very interesting that you're the contrarian and you're saying the European markets will outperform the U.S. market going forward.
Yeah, and if you actually look at it, you look at the ratios of, say, like Italy, the Italian stock market to the Dow, or whatever, the Italian I shares to the Dow, or the emerging market, that all started shifting in the summer. Now, is it just a bounce that will last a couple months, or is it the start of a longer-term trend? I think it's the start of a long-term trend with kind of this risk-on trade-on again. And it's not so much money leaving the States, and you're right, there was a flight to quality. And by the way, it wasn't just the U.S. It was basically liquidity. The German markets, the British market, all of these countries which are large, like, financial centers and weren't like, the quote-unquote pig countries, those were the countries where you were seeing the flight to. Like, even though, the British economy's in a recession and they have some debt issues as well and they're going through austerity, if you look at the chart of the FTSE, it actually almost looks like the Dow. Like, it's held up a lot better than a lot of these emerging markets. And a lot of the European markets. So it was more like a flight to liquidity, a flight to Germany, a flight to England, a flight to the United States, and basically the flight to the economic, like, centers of the Western world, and a flight away from everything else. And now I think we're going back to everything else, and that everything else on top of Europe and emerging markets, I think, includes gold stocks and natural resources and commodities and that sort of thing. Again, the reinflation trade.
Okay, so you would say then that we had, a really bad correction period, especially in the resource stocks. We had the risk off, and a lot of resource stocks, baby thrown out with the bathwater. So you would say we're slowly starting to get that risk on, where some of that larger pools of capital are coming back into the resource sector now?
Yeah, I think like what people don't understand about inflation is, I kind of agree more with Milton Friedman than anyone else that, inflation is and has been a monetary phenomenon, that people are looking at the slowdowns in China or the slowdowns in Europe and thinking that this is like deflationary in nature. Okay, it's maybe deflationary in that like housing prices aren't going to go up in either of those two places, and wages probably aren't going to go up. But it doesn't mean the cost of stuff is going to go down. We've seen that the United States has been essentially, you've seen more weakness than strength in the economy over the last 10 years since the bursting of the dot-com bubble, yet oil, has gone from $20 a barrel to, $120 a barrel or near $100 a barrel, and gasoline prices are way higher. And that's because we've seen a lot of printed money, first in reaction to the dot-com bust, then in reaction to the housing bust. And then you have, too many dollars chasing too few goods. And when you're debasing the value of your paper currency, people are looking for things that are going to hold value. So not only gold and precious metals, they're looking for all commodities. So I think with like Europe printing money, the U.S. printing money, China and India are both loosening because their economies began to slow. We've got everyone around the world essentially printing money. And this is why it's a little different than, say, 2010, 2011, when after the first move higher after the 2009 lows, India, China, and Europe all started to tighten a bit. Now everybody's loosening. So I'm I'm pretty bullish on commodities. And actually, another interesting note with my commodities macro cycle, I've equated the 2008 crash to the 1987 crash in stocks, the 2008 crash in commodities. And then after that crash, you saw about a 3-year rally from 1987 to 1990, followed by a more tame bear market correction in 90. And then the commodities market basically began to move higher for most of the rest of the next decade without even a 20% correction. And I think we've seen that correction. Like you look at the CCI index from 2011 to earlier this year, and we've now begun another major leg up in commodities. Now, there's always going to be rotation. It looks like a lot of the soft commodities, the grains, are leading this time around, and it looks like the energy complex might lag as opposed to the 2002-2007 cycle when energy really led the way. It also looks like the gold and precious metals may do well. May be strong as well. And you even look at like stuff like, the quote unquote Mr. Copper, like the copper, still 370. And what's funny is it's come off from 460, but really it hasn't collapsed or anything. And it's still at the higher end of its range. And really, if we're going to see this collapse in the global economy, you think copper would be signaling that, and it's not signaling that at all. So I'm actually probably bullish and constructive because India did some very important reforms to their economy. China is actually doing stimulus. And Europe, on top of the fiscal austerity, which will pay off in the longer term, is also making, Portugal, the pig countries, Portugal, Italy, Greece, Spain, they're making those countries modernize their economies, kind of similar to what Germany had to go through 20 years ago. It's funny because the Germans are making them do that. So I'm actually much more bullish on macroeconomies in the short to intermediate term. Longer term, I'm not as bullish because I think the U.S. is going to have to deal with its deficit problem, and I think that's when you could get a secondary like double dip. I guess it's long enough where it's not a double dip recession, but some kind of real slowdown in the U.S. probably sometime starting in 2 or 3 years or so.
Yeah, I have some mixed opinions on the commodity space because, I don't think copper is going to crash per se, because I think China is going to basically put in a permanent bid for copper because, they want to get out of their $3 trillion plus in paper holdings, and they know they can't put all the money, obviously, into physical precious metals. Those markets are just not big enough. So they're going to put some of that money into buying oil and storing it, with an expanded strategic petroleum reserve, and then they're going to put some of that money into, building out warehouses and building buildings with excess copper they really don't need at the moment. So I don't know how much copper will go up each year, but I don't see like a super spike in the copper price where copper went from, 50 cents a pound 10, 12 years ago to, $3.70 a pound now. I don't see that kind of price move in copper.
And again, I tend to be right now in the commodity space more bullish on the soft commodities because I think this drought that happened in the States is going to have a lasting impact. and the gold and precious metals arena because of, the monetary stimulus and kind of, again, the rush to protect yourself. But I think you made some excellent points that no one talks about. All these deflationists are always looking for doom and gloom and crashes. They don't talk about the fact that, yeah, you're right, China's got trillions of dollars in reserves. And you know what? They're going to sit on a copper bid at $3. They're going to sit on a gold bid at $1,500. They're going to sit on an oil and gas bid at $80. So they're sitting there, and they actually want these things to come back to them. So, and if you look at, like, for example, in the precious metals realm, most of the buying comes from Asia. So it's hard for me to see gold going back below 15 to 1600 because all the Asian central banks are going to be buying up gold like crazy if you got another correction to that area. And actually, gold looks like, if you look at the seasonal pattern, you technically tend to be weak to the end of October or so, and it looks like after that, I think we're really going to start it. Like, I think this is and if you look at the consolidation pattern as well, technically the consolidation last year, I think this is a really strong technical up leg in gold, especially the precious metal stocks, because they haven't done anything in a few years. They're still actually right about, the HUI is right about at its 2008 high when, gold was 1,000 and now it's 1,700. So I think you'll see some real outperformance in the equities.
Yeah, I agree. And the last 12 months or so, Dave, the input costs for not just the gold and silver miners, but for basically every miner, the input costs have gone up a lot, pretty much every single quarter. And then the gold and silver price have not gone up. So obviously Wall Street doesn't like that when they don't meet earnings, when they can't control costs. That's why Wall Street doesn't like a lot of the miners. That's why really, like, for some of the stocks, only the gold and silver royalty companies have done well. Sandstorm Gold outperformed a lot of the gold miners despite that price. So I think, though, we are going to see a reversion to the mean here because as gold goes up, the miners' input costs, like oils, come down a little bit. And just on the technical charts, I'm not a chartist like you, but if you look at a long-term chart, like a 5-year chart or max chart on the GDX, you see a really strong double bottom in there, and there's a cup with a handle forming too after that.
Yeah. Like me and your friend Jordan Royburn, the Trendsman, we've talked about this. That that double bottom you talk about. That you had this bottom back in the spring, the retest kind of hold in the summer, and then now you've turned above, the 50, 150, and 200-day moving averages, and you've got that golden cross. I prefer the 150 to the 200 in the long-term average, but you've had now the 50 cross the 150 to the upside. I just so you know, I do the charting more to confirm what I'm doing. I'm actually more of a fundamentally based type person, but yeah, I definitely think that it looks like, again, the seasonals played in perfectly. You get that rally in August, September. You get this pullback or consolidation into October, maybe early November, so maybe into the election, and then we get moving. And I think the catalyst going forward for all of these markets, and especially the reinflation trade, is that I don't think it matters who wins, is that fiscal cliff is going to be put off to 2014, and that's going to give the markets a sigh of relief, at least for another year. And I think you told me we were going to talk about the election. Mm-hmm. If you want to just kind of segue into that, I'm of the conclusion I don't think it really matters because I'm a bit of an outsider because I'm Canadian and I live offshore. I live in the Bahamas, and so but I think being an outsider, you sometimes maybe a little more non-biased or unbiased view. My opinion is the real problem is in the U.S., like the structure of the political system, where the lobbyists have too much power, and I think in the 2008 election, if you actually looked at it, McCain and Obama got the exact same amount of money from Wall Street, each of them. So that kind of tells you the problem right there. And I think whoever wins will have lobbyists in their pocket. See, I personally believe in what David Stock says, and he used to be the budget head for Reagan. He thinks that there has to be a crisis. You have to see what's happening in Europe, where rates spike to 5, 6, 7%, and then your back's up against the wall because you can't finance the debt, and you're forced to make cuts and restructuring. And I think that the politicians will continue. I laugh at the fiscal cliff because at some point you have to raise taxes and you have to cut spending. To me, that's a no-brainer. But so to act like this fiscal cliff is something you can keep putting off, no. You're over the cliff right now. You're just Wile E. Coyote sitting there on no way. and at some point you're going to drop down. So at some point we have to like take care of these structural problems and the deficit issues, and it's just a question of when rates go up, and we'll force the politicians to do that. Now, from this is where maybe I do think there's a bit of a difference, because Romney has a finance background, and because his job is he basically cut up companies. He'd probably be more willing to do something on the fiscal side, and Obama will be a second-term kind of lame duck president. And I think Obama, it reminds me a lot of Pierre Trudeau, who was kind of a more socialistic prime minister up here in Canada in the 70s. And I don't see him really trying to cut anything or do any form of austerity. He's going to try to just coast through his second term if he wins. So and that's what usually happens in second terms. And so I kind of would see from the fiscal side of things, even though the Republicans kind of borrow and spend, and the Democrats tax and spend, and the Democrats actually in recent times have had better track records, or Democratic presidents, of fiscal austerity. I would think that in this case, I think Romney's actually a lot better than Obama. But again, I really don't see anything until their backs are both up against the wall.
Exactly. And, like even the Ryan plan, the Paul Ryan plan, is the vice president for Romney. It's just a decrease in the increasing rate of spending. It's not a real decrease in spending. So it's just all talk from these guys. They don't really have any real solutions. I mean, the real solution should be allowing small businessmen and entrepreneurs to grow. The problem here in the U.S. is unemployment and jobs. There's a lot of people here in the United States that are working 2 or 3 part-time jobs just to pay their rent and food bill and stuff, and living paycheck to paycheck.
And I think this is the problem with the whole system becoming politicized. Like Business Insider recently had this really bogus article, in my opinion, on the stats of why Obama should be reelected. And they showed, the decrease in 2008, 2009, and then the rebound, and, the economy's got steady 1% to 2% growth since. But I tell people, what price are you doing this? You've doubled the national debt in 4 years. You're running 1.1 to 1.5 trillion dollar deficits a year, which is roughly between 7.5% and 9% of GDP, which is absolutely disgusting. Like in Canada, we never got above 6 or 7%, even at the depths of our crisis. You're basically borrowing one in every $3 to run the budget right now. So what? To keep the economy on life support when there's no real job growth, just to make the numbers look good, you're basically bankrupting the country. Those statistics are ridiculous. And then there hasn't even been employment gains. Okay, sure, the numbers have shown it, but the problem is the number of people that have dropped out. If you include those with the unemployed, the participation rate has gone from 66 to 63.5%. Those 2.5% of people represent essentially the same amount of people, the same amount of jobs that have been created. The number of people on disability has gone from 5.5 to 11 million in the last 4 years. So you're telling me that there's twice as many people now disabled as 4 years ago? No, that's the old socialist trick that, you give these people all this money. Number one, you get their vote. Number two, you take them off the unemployment rolls. And number three, like I said, you make them dependent on the government so you get their vote. So nothing's really changed. Actually, if anything, the unemployment rate in terms of, you said, people who have stable, full-time jobs that pay well has probably still gone down since 2009 if you did more of an unscientific study about it. And these structural issues have to be fixed. And we're not going to get into that part of it. But right now, there's no real recovery. And I think both parties should accept that, by the way, and try to, as you said, maybe take some of the onerous restrictions off small business. The United States, growing up in Canada, I always thought Canada was like a socialist kind of basket case. In the U.S., like this free market entrepreneur place that like the smart people and rich people in Canada move to. But right now,
it used to be like that.
More, but it's if you look at like the OECD, that thing of the gauging of economic freedom index, Canada is now like 6th in the world, and U.S. is 18th. It's amazing how the way things have kind of turned around. Now, there's other things that are symptomatic of the bubble. Canada has a better banking system. The U.S. banks are still kind of deleveraging, as is the U.S. consumer. And by the way, that's the last point on the macroeconomy. The debt to GDP at all levels went from just over 100% in the 60s and 70s to 350% at the height of the credit bubble. It's now 320%. And as long as that remains over 300% and probably working back down to 200 or 250% long-term deleveraging, as long as consumers and businesses are deleveraging longer term, there's really not much the politicians can do. This is a kind of a long-term 10 to 20, 25-year cycle even that's going to take to play out.
Yeah, and the Americans need to rebuild their savings base. They're spending more than they produce. Obviously, a lot of them don't have jobs. They're running up huge credit card debt. Our government even runs up a large credit card debt. So this is a structural problem, like you said. And I think the U.S.'s economy is basically stuck in stagflation here. As long as the Fed's going to continue to come in and print money, let the government run massive budget deficits, and then monetize it with quantitative easing and stimulus, and then give the banks, after they've speculated and made bad derivatives bets, give them fresh new dollars and pull the crap off their balance sheet. I think there's a good argument that we're going to be stuck in stagflation for at least a while longer.
Yeah, I agree with you. It's the deleveraging. It's like a more inflation kind of version of Japan, where the central bank's been a little more aggressive than the Japanese central bank has been in the last 20 years, and especially during the first few years. So and because the U.S. is the reserve currency, they're more about devaluing the dollar. Even if it doesn't fall against the euro, they're devaluing it in terms of printing more currency. So I think it's right. It's a more stagflationary version of Japan. But here's the question, though. You talked about monetizing. Does at some point, if the dollar kind of turns around, see, this is my scenario, and this is kind of my negative scenario for 2-3 years out, is let's say all the austerity measures in Europe start to pay off. In 3 years, the British deficit is 4% of GDP, and Spain and Greece and Italy are all down to 3 to 4% of GDP. And say the U.S. does nothing, and then keeps pushing off this cliff. Then all of a sudden, all the vigilantes say, "Hey, it's time for you guys to get your act in line." And unlike Japan, which has less than 5% of its debt owned by foreigners, 40% of the U.S. debt is owned by foreigners. And then maybe do you get a run? That's the kind of, I guess that's kind of, the $64,000 or $64 million question is, does that happen? I don't think that happens tomorrow, but definitely I think it could happen as soon as 2014, 2015, and definitely by the latter part of this decade.
The issues are going to come sometime around 2015 or 2017. It could maybe a little even sooner than that, where the U.S. continues to increase spending and they can't even pay back the interest payments on the debt. Because right now the U.S. can pay back the interest payments, but even at low rates right now, if we keep on borrowing more, eventually we're not going to be able to even pay back the interest payments on our national debt, and that's when the numbers stop working. But unfortunately, Europe and Japan also have the same problems. So, Japan could go first, and Europe could go, a number of the countries in Europe could also go first, because the hedge fund manager Kyle Bass has kind of been saying that he thinks Europe will go first, then Japan, and then the U.S., all in the next 5 years.
I think Europe's kind of gone through it, though. I think that, you already had those 5 to 7% rates. And here's the difference. I'm more negative on the U.S. longer term than Europe than Bass. And I know he made a lot of money in subprime. I agree with him on Japan, because the thing about Japan is first I'll talk about Japan. Japan, their debt to GDP is so high that all will take Japan's not rates to go to 6 or 7%. It will just take rates to go to 3 to 4%. And because all the debt is domestically owned, what they're going to do is do a haircut. They're basically going to tell all the citizens, you know what? I know you say owned $1 million yen worth of debt. Sorry, we can only pay you back 500,000. So it's actually going to screw over the Japanese people, and I think Bass has said something similar to that. So I agree with them there. And But another thing you got to remember too, Japan's socially a very conservative kind of nation. That's one reason the rates have stayed so long for so low. So there's actually, even with their negative demographics, there's some things that can keep rates low for a while there that I don't think Bass actually takes into account. With Europe, I think the thing is Germany, and actually I tend to agree more with Jim Rickards on this. Germany is forcing the German production model on the pig countries. Get your labor laws updated, start producing goods, and cut your fiscal deficits, kind of what Germany had to go through in the early 90s when they modernized. So I'm not as negative on Europe as Bass is. I think Germany is going to push them to do that. And one thing that maybe Bass doesn't talk about too is in Italy, in a lot of places in Europe, the savings rate is 12%. It's not 2% like it is in the States. So a lot of Europeans on the private level don't have the debt problem. Italy didn't have a big, like property, huge bubble that blew up in its face. Spain did, but Italy didn't have that. And Italy's structural deficits, for example, are much lower than the U.S. So I actually think a lot of that first phase of the European crisis is sort of gone, and and maybe there will be a second phase in 2 to 3 years, but I actually kind of see at some point the shift moving to the States more than it has in Europe. Now, in Europe, I think the second problem is going to be right now, this is where Bass could be right, what is the growth outlook like? We know they're doing austerity. We know there's going to be a recession the next year or two. Does that become like an Eastern Bloc kind of recession, where a lot of, after the fall of communism, a lot of those Eastern European countries were basically in recession for 5, 6, 7 years, and the whole system collapsed? Or is it just something because of the austerity, growth slows down for a couple of years here, then it picks kind of back up? And what we must remember about austerity, this will be my last point in all of this, is austerity, unlike someone like Paul Krugman would say, is not the cause of the problem. What's been the cause of the problem is that these governments have spent too much money for too long. And now austerity, which drives down, economic growth, is the symptom of that overspending. And we must remember that. And austerity actually, in the long run, will actually solve the problem.
Exactly, and capitalism isn't about unlimited growth. That's what Keynesian economics is, because Keynesian economics, which is what Krugman's a neo-Keynesian, he wants to be counter-cyclical, and he wants to keep he doesn't want a recession, he doesn't want a contraction in growth and government spending, et cetera, and he wants to, put his foot on the gas and keep it going.
Yeah, and I think, like I'm not a complete Austrian in that I have no problems with government spending if it's allocated in the proper manner. The building of the highway system was a phenomenal success back in the 50s and 60s, or the Marshall Plan to rebuild Europe after World War II is, if you're an Austrian economist, you just said that didn't work to stabilize the Western world. I think you're incorrect in that. But I think the problem is, Obama could have done something with the stimulus. You could have built a high-train speed network. You could have done something form of the Pickens plan, where you got the country off gas and we're running everything on natural gas by now. And the U.S. is kind of like the Saudi Arabia of natural gas. But the problem was all that stimulus did was go into his union buddies' pockets and kind of, again, manufacture growth, like that bogus Business Insider article, that it just basically, government spending is factored into the GDP number. So you spend enough money, you can make it look like the economy is growing, and it's not. So the thing is, that's all it kind of did was manufacture this artificial growth and go to his political connected buddies. When I would travel to the States, I'd drive down these highways in Virginia that were being rebuilt. And guess what? It wasn't being rebuilt by a Virginian company. It was being rebuilt by some big company in Illinois that was politically connected. It's bogus. So I think it could have been allocated, but it wasn't.
Okay, Dave, I think that was great. So we'll wrap up the interview here. Let me summarize some of your views for our listeners. So you think that the stock market will go up probably in nominal terms over the next few years. It will continue to go up in nominal terms, but you think the European market will probably outperform it, at least in the near term. And you are also bullish on precious metals and agricultural commodities over the other commodities.
Yeah, and actually the last thing I should add to that, the two sectors, I'm a total contrarian, John Templeton, buy at the point of maximum pessimism kind of guy. As an offshoot of the commodity play, I'm really liking the solar and the coal sectors right now. They're beaten up 80 to 90%. The valuations are dirt cheap. You're going to get to the point where, you get the wheat from the shaft. Like, you're going to get the strong companies emerging from this bust that's happened in coal and solar in the last 4 years. So I definitely would look at those sectors as well as kind of a contrarian bottom-feeding value play.
It's very interesting. Some very good thoughts. So can you please tell our listeners about your work and your books and where they can find you on the internet?
Yeah, my book is The Great Super Cycle. That's available on Amazon.com. My website is addictedtoprofits.net. I have a free version of the newsletter, and on the free version, I usually just post interviews that I do like this, some free blog articles, that sort of thing. And then I do offers to the pay letter from time to time. I haven't done an offer in a while, but because I've been doing a lot more media recently, I'm thinking about doing an offer probably sometime in late October or November. So if you sign up for this, you'll get a chance at that offer.
Okay, great. And thanks for coming on, and hopefully we'll have you back on soon.
Yep. Thanks very much.